Welcome to Real Estate Investing for Women. On this show, you will learn how to create wealth through real estate the blissful way. That means with very little stress and very little time. We talk about strategies, mindset, heart set, money smarts, resources, and so much more to ensure you're able to create the success you most deeply desire. Now, here's your host, Moneeka Sawyer.
Welcome to the Syndication series, where you're going to learn all about what syndication is and how you can utilize it to build cash flow and grow your wealth. It's a really exciting strategy, and I'm looking forward to sharing all of our guests with you. So now let's get to the show. Today, I am so excited to welcome to the show, Chris Larsen. Today's guest, Chris Larsen, is the founder and managing partner of Next Level Income. Chris has been investing and managing real estate for over 20 years. While still a college student, he bought his first rental property at the age of 21. Yay! I love people that get into this industry young. Ladies, hear that. If you're young, get in. From there, Chris expanded into development, private lending, buying distressed debt, as well as commercial offices, and ultimately syndicating multifamily properties. He began syndicating deals in 2016 and has been actively involved in over $225 million of real estate acquisitions. Chris is passionate about helping investors become financially independent. Hello there, Chris. Welcome to the show.
Moneeka, thank you so much for having me. I'm really excited to be here.
Yeah, I've been so looking forward to this show, and you've been so patient with me with all the rescheduling. So thank you. I'm glad we're finally here. Yay!
Likewise. Yeah.
So Chris, give us kind of a high level of your story. I know it's very exciting.
Yeah. So first off, I love you bring up, get started early, now is early, right? Like whenever you can do it. I was 21, I was in college, and kind of to rewind a little bit, my passion at the time was racing bicycles. Now I went to Virginia Tech for engineering, biomechanical engineering. I did pretty well in school, and I was told like, oh, you should be an engineer like your grandfather. Well, all I want to do is race bicycles. And cycling is like a real engineer sport because it's all about numbers and power to weight ratios. And at that time, drugs, which I wasn't into. So that was kind of the end of my story in a lot of ways because I didn't want to do that. But along the way, kind of at that same time when I was at this turning point, trying to decide what to do as I was looking towards a professional career, my best friend, roommate, training partner passed away. He had a massive brain hemorrhage between my freshman and sophomore year in college. So I poured another year into the sport. And then I realized even after I was winning more and more races that I wasn't happy. And even though my team went professional, I didn't. I stepped away from the sport, went back to school. And now as a junior in college, I thought like, what the heck am I going to do with my life? I don't want to be an engineer. I was going to go race and then figure out what I wanted to do. While I was racing, and even when I was young, the first thing I remember, and probably if you're listening, you think the same thing, like you hop on your bike and you have this tremendous sense of freedom. And that's what I wanted. I wanted freedom. And I wanted the freedom to live life on my own terms, to not only respect the life I was given, but also the life of the friend that I lost. And I turned towards investing. I was introduced to it by the same gentleman, Clint Provenza, who introduced me to cycling. My father passed away at 5, and he was a real mentor to me. So I started looking into investing. I was day trading, and one of those nights/mornings at 3 a.m. when I was laying there in bed thinking about what I should do, with my trades, I thought like, do I really want to be doing this 20 years from now? The answer was no. So I looked at other investments. I read over 250 books on money, investing, and settled on real estate because you could control it. I bought my first property at 21, as you mentioned. I built and managed a portfolio of single family rentals for 15 years, but ultimately transitioned into commercial real estate. And that's what we focus on today. And I try to enlighten people and share my mistakes so they can take the fast track to get towards financial independence, which took me almost 20 years.
Yeah, it's so interesting. I have a very, very similar story in that I wanted to be a dancer. So that was like my thing. And I came to investing for a similar reason. Like I wanted a life of choice. I think that freedom of choice is our true wealth. And so
Yes.
that's what I wanted. And real estate really allowed that. And it did take me 15, I think it was 15 years before I could really say I could retire, my husband and I, but I couldn't do it the kind of lifestyle that I wanted in California. Like we would have had to move. So we continue to grow our portfolio, but it was that same thing. Like after about 15 years, I was like, we really are doing everything now that we're doing because of the choice, because we want to do that. Right. And there's nothing more liberating than that, you know?
Yeah. Well, I think studies show, like I would teach a financial literacy course here. So it's high school students, you know, they're coming out of, you know, really, you know, underprivileged homes. Most of them are living below the poverty line. And we had a conversation about, you know, at some point, income is important, but really it's the freedom to choose. And I cited the study that shows the janitors that have freedom in their day-to-day choices are happier than the CEOs that are, you know, making 100 times 1,000, what is it, like 10,000 times now what they are, but they're not happy because they don't have freedom.
Yeah. I think that's absolutely true. I do actually, my TED Talk, I was telling you about this. My TED Talk is about this. Yeah. And there's a lot of research about there's actually a threshold where money does buy happiness to a certain threshold, because
about 70,000. What's that number?
The original number they came up with in 2010 was 75, but a study was done January this year, 2021. That said it was 100,000. So it's gone up because of inflation, that makes sense. Obviously. Yeah. But whatever that number is it's 100,000 now. Basically, up until then, the numbers of dollars that you bring into your household actually does relate directly to the level of happiness in the household or the level of satisfaction. But then after that, now we're looking at we have freedom, we have excess income, we are taken care of, and now we can focus on joy. Bliss. That's
so good. Right? I can't wait to hear your TED Talk.
Yeah, I was like, oh my God, this is so stressful and so much fun. So anyways, so good. I'm so glad we're on the same wavelength around that. So talk to me about this concept of infinite banking. Tell me what you mean by that.
Yeah. So next level income was really born of this desire to curate information around financial literacy and education. And you know, as I built it out, we have three main areas. We talk about how to make, keep, and grow your money. So those are kind of the three steps. And I have coaching clients, and that's what we work through. Like, how can you maximize how much money you're making, right? How can you keep more money? And that's typically around entity structure, tax strategy, but also this concept called infinite banking. So if you think about what your biggest expenses are in life, most people know that, taxes are one, right? Like if you're making a lot of money, if you're listening to the show and you're at those higher income levels, 20, 30, you're in California, even 40 or 50% is not uncommon. Well, that's a big expense. But the next biggest expense that a lot of people don't think about is financing. Think about how much money you spend on interest for your house, interest you spend on cars. If you have a business, business loans, if you have infrastructure equipment, all those things. So if I said to you, what if you could take that financing dollars that you spend on interest and put them back in your own pocket? What if you could become the bank? And that's really what Nelson Nash talks about in this concept of becoming your own banker, which infinite banking was born of. The other thing that's great.
Could we stop for just a moment? There's a question I want to ask you because I think you'll actually have the answer to this one. Yeah. On average, when you pay a mortgage, when it's fully amortized, right, you pay a lot of interest in the front end and it goes down, blah, 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 that whole thing. But when you look at the very end, if you actually were to finance out for 30 years, what amount of money relative to your principal do you end up paying? Isn't it something crazy like 3 times as much?
Yeah, it's two to 3 times. So at today's interest rates, they're lower, right? Mm-hmm. It's more like 2 times, but historically it's about 3 times. So if you buy $100,000 house, let's not pretend you're in California. If you buy $1 million house, you're probably paying $3 million. Yeah, you're probably paying $3 million. So your average home in America, $300,000, you're probably paying somewhere between $600,000 to $1 million for that home, and that doesn't take into account when you refinance. So a lot of people refinance, they reset the clock,
And you pay
and
more interest.
And you pay more interest. So a lot of people never get out from under that.
And so ladies, I just want to give you a little clarity on that. I know I just talked really fast there. So what happens on a fully amortized loan, it's not what we call simple interest. A fully amortized loan means it's heavy on the interest on the front end. So let's say like 2/3 of your payment, your mortgage payment goes into interest, and 1/3 might go into your principal, and then it moves over your 30 years. So at the end, you're paying significantly more in principal. I don't think it does an exact flip, but you're paying a lot more in principal and significantly less in interest. So every time you refinance, you start that clock on the heavy interest side. So in the past, ladies, you have heard me talk about, I like interest only loans. That's because I don't stay in homes very long. I refinance them to take money out so I can buy something else. So I'm always high on the interest side anyways. So this is a way for me to control my cash flow, doing what I would normally be doing anyways. So that's just something that, like, when you think about, and now when he's going to talk about infinite banking, understand that you're paying 2 to 3 times your principal. And he's talking about now how you can put that back into a way for you, that to work for you rather than you paying that out. Is that correct?
That's correct. And that's a great way. So I hosted a radio show in college, or co-hosted, I should say. And one of the financial advisors, she advocated for a 15-year mortgage. And I said, no, you want 30-year. That's right. Because I said, you want to have the money in your pocket and the ability to pay off your mortgage, because ask yourself, what's your return on equity? It's zero. The money's just sitting there. It's not doing anything for you. Mm-hmm. Moneeka, you said it perfectly. You can go out and use that money. You can finance, you can buy another property. You can leverage that. You can use the bank's money to do that. Mm-hmm. If you have your home paid off, you have to pull that money out with the permission of the bank. Now, what's interesting is whole life is very similar to owning a home. Term life insurance is very similar to renting. You build up equity in that policy. But here's the thing that's great. When you have a properly structured life insurance policy and you build up that equity, you don't have to ask anybody permission to take that money out. You own that policy. The collateral is your policy on your life. And the insurance company has to lend you the money before it lends out to anyone else. And by the way, they have to lend that money out to earn a rate of return, because the other neat thing with life insurance, and this is unlike your home, but kind of similar, your home goes up in value. Life insurance does too, because they pay dividends. The insurance company invests that money. If they invest it well, what happens is they earn a return on that and they give it back to the policyholders. And you have to make sure, this is really important with this concept, you have to have the right insurance company that you're working with, and you have to have a properly structured policy. So yes. Just like you can go buy, the wrong mortgage for your home, there's multiple types of mortgages, or your investment property, you have to make sure you buy the right policy with the right structures. And sometimes there's multiple structures within that. So it can be quite complex.
And I love that you mentioned that. I actually was on the phone with one of my ladies earlier this week. And she was saying, well, I've got something with State Farm, and I don't know how State Farm is structured. So this is not a good or bad.
I do. I work for State Farm.
Okay, good.
Yeah.
Okay, good. So that's great. But one of the other ladies that was on the same call with me said that she ended up trying to structure the infinite banking structure. But what ended up happening is when over time, I don't really know how it all worked for her, but over time, she wasn't actually going to end up paying taxes on the money, and she was horrified. So I guess what I'm trying to say here is there are lots of different kinds of insurance companies. There are lots of different kinds of whole life structures. So if you're actually, depending on your goal, this is like with anything else, whether it's investing, getting married, having a job, you have to know what your outcome is that you're looking for. Is it, what is going to be paid to my family when I die? Is it, can I use this money? Is it, I would rather not pay taxes? Is it growth? Like, what is it? And then once you make that decision, you have to actually find a policy that is structured to reach that goal in the best way possible.
That's exactly right. You said it perfectly. So yeah, and you have to work. And the unfortunate thing is there's a limited number of companies that can do this. You want to optimize the company for your certain circumstance. So if you are a 50-year-old woman, the company you might work with might be different than a 30-year-old man or a 80-year-old woman. So it just depends on what your certain circumstance is. And the other thing is, if you work with an insurance agent that's going to structure this policy, they're actually paid less commission to structure the policies this way, because when you maximize the cash value, you're optimizing the insurance level. And when you optimize that, it means you a lot of times will lower it. So you're lowering the cost of insurance, and the cost of insurance, a big portion of that in the initial years is the commission, and it's paid to the agent, which again, I've been in sales my whole life. I don't think there's anything wrong with paying somebody for the service you provide. And that's part of the thing. If you're listening, you may have heard things like, oh, life insurance is a bad investment. I don't call it an investment. I've used it for over a decade now, about a dozen years now, this exact type of policy structure. I wouldn't call it an investment. It's like a supercharged savings account. It's a tool that you can use along your investment journey. If you're a small business owner, so if you're listening and you say, well, I own a small business, what's cool is you can also structure it for retirement. You can use it almost like a Roth IRA. But what's nice is, unlike a Roth or unlike a 529 plan for your kids, you have a lot more flexibility. You can use this money for whatever you want along the way.
Well, and the other thing that I love about these is that depending on how it's structured, right? You were talking about different ages. If you're 20 versus 80, you can put together a policy where you're doing a monthly installation. You could also put together a policy where you have one installation, right? Your business did really good this year. Maybe you put $200,000 in, and then you just let that ride for a while. So there's different ways also to structure it. So you don't feel like in the old world where this was going to be a payment every single month. And I don't want another payment every single month, especially if you run your own business. You don't know what next year is going to look like, right? So that's what these newer policies are really interesting, because there's so much flexibility and there's so much new opportunity in structuring to create other ways of using them.
Absolutely. And we have a whole page. So at nextlevelincome.com, we have a banking page, and you can check out some of the resources there, videos, white papers that talks more about this as well.
Nice. I love that. Do you feel complete on that topic? Did you want to move to the next one?
I'm good. So I edited my book. I added a chapter. I know I didn't mention it, but that's the other thing we have on the website. So if you want to learn more about it, you can also get a copy of my book for free. If you go to nextlevelincome.com, you can click on the book link. I'll even send your audience a copy, Moneeka, if they put their address in.
I love that. Thank you so much. So talk to me about your perspective on multifamily. This is a hot topic with my ladies. So.
Yeah. When I'm trying to figure out, when I hear you say that, I'm like, how can I figure something out? So on my podcast, I can say my ladies. I don't know if I'm ever going to figure that out or not. And that's probably a good thing, but, I don't think that's not going to be my tagline. But I might think on that a little bit longer. So yeah, I call multifamily real estate the holy grail of investing. Mm-hmm. And so if you look at my book, it says how to make, keep, and grow your money using the holy grail of real estate to achieve financial independence. And like I said, I'll send you a copy for free if you go to the website. So I'm so high on multifamily. I was the guy the person that managed my own portfolio for 15 years. I was the person that got the phone call on my honeymoon in Costa Rica and paid $40 in collect call fees to deal with a problem tenant. I was the guy that stayed in too long and didn't get a great return on my properties. And I was also the guy that was fortunate enough to run into somebody that introduced me to this space. So about 9 years ago now, I started to investigate multifamily real estate, and I'm a demographics guy. I spent 18 years in the medical device industry. That's how I made the money to invest. And I got into medical device. I moved to North Carolina. I live in Asheville, North Carolina, because we have great demographic trends. And when I started to investigate multifamily, being an engineer, being a data guy, being analytical, I found that multifamily was supported by these terrific demographics by what we now call the millennials. They rented. And guess who's supporting multifamily now? It's their parents, the baby boomers. They're selling their homes, they're renting, and now Gen Z is renting as well. So we've turned into this nation that, yes, we like to own, that's the American dream, but we also like flexibility. And I jumped into multifamily It was because of the demographics, but it was also because of the analytics. My MBA is in portfolio management. And what I found is something that Ray Dalio calls the holy grail of investing, which is it allows you to increase the Sharpe ratio. And, don't let your eyes glaze over. Just listen to this point here.
Yeah.
The Sharpe ratio, I'll simplify it. It increases the returns of your portfolio and decreases the risk. So it's like a boat that goes faster and it has less bumps when you're on it. So I thought, well, what is better than that? And Ray Dalio calls that the holy grail of investing. So I call multifamily the holy grail of real estate because it allows you to increase the returns in your portfolio and allows you to decrease the risk.
I love that. So good. So I know that in Extra, we're going to talk a lot more about multifamily. So we're going to give, just so you know, we're going to talk sort of about high level, why he loves multifamily so much. I think we'll talk a little bit about that right now, but we're going to go deeper in sort of the pros and the cons of multifamily. And then he's going to actually do some number breakdowns for us. These are things that I get asked about a lot. It's not my strong suit. And my husband and I have not been involved yet in multifamily. So the commercial evaluation of the numbers is not really his strong suit. He hasn't had to do it yet. So this will be really, really fun. In Extra, we'll be talking a lot about that stuff. But why don't you kind of give us a high level, Chris, on why you like multifamily? Like what's so exciting about it?
Yeah. So there's a few things. So if you're listening and you're like, I love real estate, but I don't want to be the person that has to go in and fix toilets and find new tenants and screen people and do showings and all that. I get that because I've done it. The big thing is if you invest in multifamily with an experienced operator, with somebody that is putting together these deals, it's 100% passive. So you can invest, you can be a direct owner, you can get the income, the appreciation, the depreciation, those great tax benefits, especially if you're a high income earner, but you don't have to deal with it all yourself. That's fantastic. It's scalable. So you could buy a 100-unit multifamily building for $10 million. You could buy $1 billion multifamily portfolio. So whether you're investing in your first deal or you've been investing for 20 years and you're looking to place $1 million or $10 million of capital, you can use the same strategy. It's very scalable. But there's something that I like even more. It's control. You might have heard me talk about laying in bed at 3 a.m., feeling like things were out of control with my money. I like real estate because you can control it. We're acquiring a property in Greenville, South Carolina, and we live in Asheville, which is about an hour away. We were down in South Carolina for my son's, their 9 and 11 lacrosse games this past weekend. And I took them to the property and we drove around, and it was built in 1997. It's a little beat up, the stairs, some need to be replaced. There needs to be new paint. Well, guess what? We can control all those things. If you own a business, you get this. Apartments are valued like a business. They're valued by net operating income. So if you live in your home or you have a rental home and it's 1,000 square feet and it sells for $300 a square foot, it's worth $300,000, right? Easy math. And they figure that out. The bank figures that out because they say, well, the home on your right is worth $105 a square foot. I'm sorry. $305 a square foot. And the home on your left is worth $295 a square foot. Yours is about $300 a square foot. You don't control that. The market goes up, the market goes down. You can't control that. If we go and we buy an apartment building for $10 million and it has $1 million of net operating income, that's probably not a great metrics today. Call it $20 million apartment building with $1 million in net operating income. And we increase the net operating income 50% from $1 million with a $20 million valuation to 1.5. That new valuation, and you're probably thinking to yourself with your calculators, $30 million. We control that when we're able to move the rents by the renovations, by the operations, by being more efficient, bringing in better management and those sorts of things. So again, it's passive, it's scalable, but most importantly, it's controllable.
I love that. So my eyes did glaze over a little bit there. And ladies, I'm sure some of you are like me going, but we will break this down. So you can listen to this again, and then we'll break down more about this in Extra. So we can take it a little bit slower.
Look forward to that. Yeah.
Yeah. That'll be fun. Okay. So talk to us about, did you feel like you already covered this? Sort of what are the important metrics? What exactly should we be looking at?
Yeah. So I'll dive a little deeper. Again, we can unpack this a lot more in the extra section. But if you're thinking, hey, this sounds interesting, what should I look out for as an investor? So I started as an investor in these deals. I was what's called a limited partner before I syndicated these deals and became a general partner. So if you're a limited partner and you say, hey, I'm interested in this, you need to look at three different things. You need to look at the geography. So are you investing in an area of the country that people want to move? And I wrote a whole blog post about this. I talk about how you can identify these. It's very easy to see with reports from companies like United Van Lines, and you can go on our blog at the beginning of 2021 and read the post I put on there. So you want to be in large cities where people are moving that are growing faster than the national average. So where are these cities? A lot of these are in the Southeast. Remember, I said I moved to North Carolina for the demographics, the Carolinas, Florida, Georgia, Texas, Phoenix, Colorado. Boise, Idaho seems to be a big one here recently. Why are people moving here? They're moving out of California to places like Colorado, Texas, Idaho. They're moving to the Southeast from places like California, LA, New England, New York, places that are cold, that don't have a great quality of life. Taxes are going up. I have a coaching client. He told me today, he's like, we're looking at South Carolina to move. Taxes are going up. Like, we just don't want to live here anymore. Number two, the operator. Are you working with an operator? This is somebody that's going and finding the property. It's going to buy the property. It's going to bring you in alongside them, and then they're going to operate it. They're going to increase that net operating income. Have they done it before? Have they done it in the geography that you're invested in? And what is their experience there? You want to ask them some tough questions. What's their strategy? And then you look at the metrics in the deal. And that's pretty complex. We looked at over two dozen different metrics on the deals that we're in. And there's a lot of different variables that come into play. But again, if you've ever invested in a business, if you're a business owner, if you're a professional, you can read a financial statement. And that's the thing. If you call me and say, hey, I'm interested in this deal, as an owner in these properties, you're entitled to all the same information that you would be entitled to if you owned a single family home. So you can go through those, and you can call the operator and say, hey, walk me through this. What am I seeing here? What am I seeing there? Don't be afraid to ask those questions and understand the numbers, the strategy, and why an operator is going into the market.
So talk to me a little bit about ROI. So different operators do this differently, right? Tell us a little bit about how you structure your deals for your investors. Yeah.
So what we do is called a syndication. So a syndication is very simple. It is an operator going out and bringing in investors alongside of them to invest. Now, what's important is how that syndication is structured. So what we do is we do what's called a preferred return. So typically our preferred return, and if you look at deals, say 6 to 8%. Now, what does that mean? That means investors get the first 6 to 8% of the returns coming from that property. So they're preferred. The investors are preferred in front of anybody else. Now, they're going to be subordinate to the lender. And the other thing that's nice about these properties is it's called non-recourse debt. So if you're a professional, I work with a lot of doctors after spending 18 years in the medical device profession. They don't want more risk. They don't want more debt. They don't want a bank to come after them for something. They have patients that are out for them if something bad happens. So that's a nice thing about these properties as well. But after the lender, the investors get that preferred return. And then there's typically a split. There's an equity split. So that split is a large part goes to investors. And then the partners that organize these deals get the minority position in there. But that's the incentive. So you want to work with a group, in my opinion, which is how we do it, is we give the investors the first big portion of the returns, typically about a half of the returns up front. And then the other half comes from that split on the backside. And then we as partners get a piece of that split. So we're incentivized to maximize the profit of that property on the back end. You asked a question there, and I'll kind of address this. There's typically a couple different ways to look at this. You can look at a total return. So, hey, you're going to get a 10% return comprised of half cash and half appreciation on a property. There's also an equity multiple. Hey, you're going to double your money over a certain period of time is another way to look at it. And then there's also what's called the IRR, the internal rate of return.
Yes.
And again, we can dive deeper into this into the extras portion of the show, or you can go ahead and check out my book, which goes deeper into this as well. And you can always read on a site like Investopedia, which dives deeper too. And it depends on what type of investor you are. Maybe cash is important to you. Maybe the total return is important to you. It all depends on what type of investor you are.
So do you pay investors immediately? Like when they first invest money, are they guaranteed a certain return each year while the project is happening? Or how do you structure that for your people?
Yeah, great question. So one little red flag, we never say guaranteed because these are investments that have a risk associated with them. Mm-hmm. So if you ever hear me say guaranteed, you should like either slap me on the face or stick like, a paper towel or something in my mouth to, but we have, so we have a couple different types of investments. So we have investments that we pay in investors a fixed return based upon the performance of the property. But our group typically pays out monthly. So we like to pay out monthly. There's groups that pay out quarterly. It's not necessarily better or worse, but personally, I like to get money in my account every month.
Okay, great. And then you get some stuff on the back end, depending on how the project goes.
Yeah. So typically in a multifamily syndication, you're going to get regular cash flow, monthly, quarterly, annually. Mm-hmm. And then when the property sells, think about it just like a rental property. You're getting rent. So if you're renting it out for $1,000 a month and your expenses are $900, you might get $100 a month. And then when you sell it, if you bought a property for $100,000 and you sell it for $150,000, you get that $50,000 profit on the back end. It's very similar to that.
Got it. Okay. Do you guys do the whole refinance structure piece too, or do you just go for the sale?
Yes, that's an excellent question. So when we model out the returns on a property, which is called a pro forma, mm-hmm. we don't assume we're going to refinance the property. Mm-hmm. Now, if you've ever owned a rental property or you have a property of your own, what's nice is if you have a HELOC, a home equity line of credit, and you pull money out of your home or an investment property, you don't pay taxes on that when you pull that money out. Mm-hmm. You might pay taxes when you sell it, but you don't typically pay taxes when you pull it out. It's really nice. It's very similar in what we do. So a lot of times we look to do that if the property is performing. We just don't tell investors that's part of the plan because we want to be a little bit more conservative than that. But that is a very optimal way to pull investor capital out in a tax efficient manner.
Got it. Awesome. Well, we dove pretty deep into all of that stuff, and I know we're going to get even deeper, ladies. So definitely stay tuned for extra. So we'll be talking more about the fundamentals of multifamily investing and the numbers around that, and then also why or why not to do it. So, but before we move towards the end of the show, Chris, could you tell everybody again how they can reach you?
Yeah. So if you're listening and, you want to dive a little deeper, you want to learn a little bit more, check us out at nextlevelincome.com. We have a podcast, which hopefully we'll be sharing Moneeka on here in the future. We have a blog, and you can also get our book for free, which dives deeper into all the different aspects that we talked about today. Just go to nextlevelincome.com and click on the book link. And if you put your address in, I'll even send you a copy for free.
Yay. Thank you for that. That was so generous. Awesome. Okay. So I didn't tell you this, Chris, but we have 3 rapid fire questions. You ready?
I love it. I'm ready. I told you I'm wide open here. So let's do it.
Let's do it. Okay, good. So Chris, tell us one super tip on getting started investing in real estate.
The best tip I can think of is find somebody that has gone down the path you want to go down and either ask them for advice or hire them to help be a mentor.
Nice. And then what would you say is a strategy to be successful in real estate investing?
Yeah, I think success in general is habits. So whether you want to be successful in real estate, successful in life, losing weight, whatever it may be, you need to focus on your daily habits. So if you want to be successful in real estate, that may be, as far as syndications or passive investments, that may be reviewing a deal every day, every week. If you are going out and buying your own properties, that may be contacting brokers, making phone calls, and getting options out there that are coming in towards you on a regular basis.
Great. So developing good habits around your business.
Good habits. Absolutely.
Nice. I love that.
Yeah.
And then what would you say is one daily practice that you do that contributes to your personal success?
I've learned a lot over the past 5 years. I just bought my older son the 5-minute journal for children. And I use the 5-minute journal. I meditate every morning. The 5-minute journal is basically a gratitude practice. And I know you're big on this. I think happiness comes before success, and you have to get in that right mindset, the abundance mindset, which is, you share, that success, that money will come to you, and there's always a deal out there. So you don't have to worry. You don't have to fight over these things. Share, help other people. Other people will help you get in the right mindset. And that's what I try to do every day.
I love that. Thank you. This has been an amazing show. Thank you so much for all you've already contributed, Chris. This has been great.
My pleasure. Thank you so much for having me.
Yay. And ladies, stay tuned for extra. We're going to be talking more about the fundamentals of multifamily. If you are not subscribed but would like to be, please go to realestateinvestingforwomenextra.com. You get the first 7 days for free. So check it out, download as much as you can, and you can stay if it's for you. Realestateinvestingforwomenextra.com. For those of you that are leaving Chris and I right now, thank you so much for joining us for this portion of the show. We appreciate you, and I look forward to seeing you next time. And until then, remember, goals without action are just dreams. So get out there, take action, and create the life your heart deeply desires. I'll see you soon. Bye.
I hope you enjoyed today's show. If you'd like to find out more about how to become a blissful millionaire, go to blissfulinvestor.com. See you next time.